Low spending tourists and slowing export growth but intact economic recovery stays on track. A volatile currency market, a slowing world economy amid war in Europe and raised geopolitical tensions as well as a brush this week with political uncertainty means that Thai policymakers must be constantly on guard even to achieve the paltry 3% to 3.5% growth that is being pursued this year. A very comfortable foreign exchange reserve level has, so far, protected the kingdom, but even this has been falling since March. Amid turmoil at Government House in Thailand this week with the suspension of Prime Minister Prachan Ocha and Deputy Prime Minister Prawit Wongsuwan taking the reins as caretaker PM, officials were anxious to underscore that the kingdom's economic recovery remains intact and on course for growth of between 3% and 3.5% for 2022. However, there are causes for concern such as a slowdown in export growth and significantly lower expenditure per capita among incoming tourists as the country still appears to be running a current account deficit. Government spokesperson Ratchathani Thanyudarek this week highlighted that the economic recovery in Thailand is continuing despite political turmoil with Deputy Prime Minister Prawit Wongsuwan, INSET, taking over as caretaker Prime Minister after Prime Minister Prachan Ocha was suspended from duties by the Constitutional Court on Wednesday. She highlighted a 14.1% surge in tax revenue in the first 10 months of the year, which ends on September 30 next. It comes as the baht has again begun to lose ground against the US dollar with increased concern over a divergence in interest rates between Bangkok and Washington. Figures released on Friday show that the rate of growth of Thai exports slowed dramatically in July from the month before from 11.9% in June to 4.3%. An earlier poll of leading economists conducted by Reuters had suggested a growth rate of 11.5% for the month. The figures were released by the Minister of Commerce and Deputy Prime Minister Juran Laksonawisit at a press conference. Government spokesperson insists economic recovery on track with growth of up to 3.5% projected for 2022. The figures are coming as the Thai government insists that the economy is on target to grow by up to 3.5% in 2022 on the back of stronger exports and foreign tourist numbers with over 1.2 million arrivals seen between the end of July and the end of August. It is not clear what the reason for the slower-than-expected export growth is at this point, but it may be linked to disruptions caused by economic problems in China and weaker conditions in the United States as well as other key export markets currently experiencing rising interest rates and persistently high inflation, with warnings that world economic growth this year is slowing with projections of 6% falling to nearer 3%. On Thursday, a spokesperson for the government, Ratchathani Thanyudarek, also revealed that the taxation yield in Thailand for the first 10 months of the year is up, with the Revenue Department collecting 1.67 trillion in the first 10 months of the year, which ends on September 30, an increase of 206 billion so far for the year or 14.1%. Figures show a 14.1% hike in tax take this year as economy fully reopens from last year's emergency. She also highlighted that despite the political challenge presented to the kingdom this week with the suspension of the Prime Minister, things are moving forward smoothly, with the budget being approved by the House of Representatives and goals set by the country's economic planners being achieved. On Friday, caretaker Prime Minister General Prawit Wongsuwan spent his first working day at Government House after the Constitutional Court suspended Prime Minister Prachan Ocha over a challenge to his tenure over a constitutional term limit. Prime Minister suspended from duty by the Constitutional Court as it takes up term limit case for hearing. The rising tax yield has been attributed to a marked increase in private consumption in the second quarter of 2022, which saw Thailand's economy grow by 2.5% and domestic consumption by 9.8%. Remarkable figures for domestic consumption in second quarter, with a 23.5% rise in spending on restaurants, bars and tourism despite inflation. The figure is remarkable given that inflation from April to June rose from 4.65% to 7.66%, while spending in restaurants, bars and domestic tourism rose by an impressive 23.5% as the country fully reopened. However, there are points of concern with the recovery, which the government hopes to bolster in the coming months by boosting expenditure to promote foreign tourism into the country as the high season approaches and pushing forward with public investment projects, which Minister of Finance Arkham Termpithayapasith, on Monday, pointed out will be worth 1 trillion this year. Minister of Finance Arkham promises the economic recovery remains intact and would be supported by a boost in public investment spending at this time. Mr. Arkham predicted that the Thai economy would grow by 3% to 3.5% this year and admitted that this was a slow level of economic growth. Indeed, the minister has consistently pointed to the setback the country suffered in 2020 when GDP contracted by 6.1% as the reason for pushing growth this year as a priority. Growth rates well behind its Asian neighbors are insufficient to power economic transformation, with underlying issues exacerbated by inequality. The economy will remain in a steady, albeit slow, recovery, and we have to ensure the recovery remains intact, Minister Arcom explained. I believe this year we will grow 3% to 3.5%, a satisfactory trend. Persistent high inflation and reduced per capita spending among incoming tourists are threats with an ongoing current account deficit and capital outflow. However, some key challenges remain, such as persistently high inflation, which will be driven higher by increases in electricity charges this month, as well as lower expenditure per incoming foreign tourist this year compared to pre-pandemic levels. In 2019, the average spend for incoming tourists visiting the kingdom was $50,251. However, figures for foreign tourist spending in the second quarter of 2022 to the end of June came in at only $31,735 according to top-line government data. There is also concern about the kingdom's current account and foreign exchange reserves, which appear to have fallen from $256.8 billion in March to $218.5 billion at the end of the month, a fall of nearly 15%. This still leaves the kingdom in an extremely comfortable position compared to other Asian economies. Capital outflow of $1.2 billion in July, with fears that a widening divergence of interest rates between Thailand and the United States will become an issue. Figures also show that $1.2 billion in financial capital left Thailand in July despite an influx of over 1 million foreign tourists, as the country's current account deficit remains elevated. Citibank warns of a tightening of liquidity worldwide later this year, feeding into Thailand's markets. This is despite assurances by the Bank of Thailand, up to that point, that Thailand had seen net inflows of capital for the year. The fear is that rising interest rates in the United States and interest rates, regionally, that are well ahead of those in Thailand, may see money leaving the country for a better return as the rate divergence widens. Most Thai people have small account balances, with 87.7% having less than $50,000 in funds, meaning capital outflow to a higher return can occur swiftly. This may be particularly so due to the traditionally unequal nature of Thai bank account balances, something that has been exacerbated by the pandemic, which contributed further to the country's economic inequality. Figures from 2020, admittedly during the height of the pandemic, show that only 1.52% of all funds deposited in Thai bank accounts came from 91.22% of bank account holders with funds of $1.128 trillion. By comparison, foreign residents in Thailand account for only 3.52% of all bank accounts with funds to the value of $596,779 billion. Figures show that 87.7% of Thai bank accounts have less than $50,000, with the average account balance being $4,241.50. Difference in interest rate return on funds between Thailand and the United States will be at least 2.75% before the end of 2022, with 3 more hikes due. Currently, U.S. interest rates are at 2.25% to 2.5% compared to 0.75% in Thailand, a divergence of 1.5 to 1.75%. The Bank of Thailand has indicated that it will continue with its modest and gradual approach to raising interest rates this year, which is expected to see Thailand with a rate of 1.25% by the end of 2022. However, despite some signs of an easing of the rate of growth of inflation in the United States, with the impact of rising prices and interest rates causing the world's largest economy to gradually slow, the Federal Reserve remains committed to further rate rises of a similar nature to that seen in July at 75 basis points in September, November and December, which will see U.S. rates of at least 4% or even up to 4.75% by the end of the year, with a very significant divergence, at that point, between U.S. rates and Thai rates, bound to accelerate capital outflow. On Friday, U.S. Federal Reserve Chairman Jerome Powell made it clear that the hawkish policy of the Fed would continue despite the pain that may be caused to the U.S. economy in pursuit of price stability. This signals that the danger of wider divergence in interest rates between the United States and Thailand is increasing. With an open market economy like Thailand's and a liberal foreign exchange regime, this is bound to see accelerated capital outflow from Thailand. Baht again loses ground against the US dollar, even though it has gained 7.6% this year against the euro. Since Thailand raised its key rate by 25 basis points on August 10, The Thai baht has lost ground by nearly 3% against the US dollar, again falling from 35.21, at that point, to the US currency, to 36.21 on Friday. At the same time, the baht has increased in value dramatically this year against the euro, which is now below par with the US dollar, falling from 39.38 in September 2021 to the same level as the dollar, to 36 or 7.6%. At the same time, the baht has been quite volatile against the UK pound, falling from the 10th of October 2021 when it was valued at 46.17 to the 14th of June 2022 at 42.06 or 8.9%, but recovering to 44.62 at the end of July or 6% before falling again to 42.31 on the 25th August. This volatility in currency values may well discourage deposit account holders from moving funds offshore, but it may also result in more currency speculation.